The idea of getting rich quick is very enticing. You'll hear about people that have gotten rich overnight. The thing is, that makes for a good story, so you'll hear about it more often, and that could lead you to believe that it is more likely than it is. You don't see many stories of people losing 30% of their hard-earned money, because that's less exciting. But I think it happens more often than people getting rich overnight. Even if you're lucky enough to get rich quickly, you have to be careful. Many lottery winners and professional athletes eventually go broke. I think it's because they got the money quickly and increased their standard of living in an unsustainable way. Easy come, easy go. If you build wealth slowly, it gives you the time to learn how to save and make better financial decisions early on. If you make a mistake early on while you're growing, it gives you the opportunity to learn from it and continue to move forward. Keeping money requires a certain mindset. You've got to be disciplined. People will reach for thousands of percent returns in the stock market, and they'll usually take on extra risk. A modest 10% return can bring you wealth if compounded consistently over long periods of time. The stock market is a machine that transfers money from the impatient to the patient. I think speculating is the impatient way of participating in the stock market. A speculator usually buys businesses without much consideration of the price. Here's an example. Let's say you hear of a lemonade stand down the street in your neighborhood and it's doing really well. Then on the news you hear that lemons help you lose weight. You think that this will increase the demand of lemonade and people will continue to buy lemonade in the future. So you go visit the stand and see that people are lined up to buy the lemonade. So you decide you want to invest in that lemonade stand. You think that since there will probably be an increased demand in lemonade, your investment will go up. So you talk to the owner of the lemonade stand and she says you can be a part owner for $100. So you think to yourself, $100? No problem. You shake her hand, it's a done deal. You're now part owner of that lemonade stand business. You then find out there are actually 1,000 owners of that same lemonade stand. This means that the profit is split 1,000 ways. Then you find out the business profits $500 a year, so your share is 50 cents. Then you start to regret your decision. In effect, you're buying part of a $100,000 lemonade stand that profits $500 a year. I would say that was speculative behavior. You were hoping your investment would go up and somebody else would buy it back from you for more than you paid, not based on any conservative calculations. I would say it was not a good investment. The problem was that the price of the business wasn't considered. The business itself can be doing great, the profits can be increasing, but that doesn't mean it's a great investment. Businesses, just like any other asset, are not worth an infinite amount of money, no matter how good they are. Interestingly enough, this kind of speculation happens a lot in the stock market. People usually look at the stock price per share. This alone doesn't tell you the price of the business. The market cap tells you the price of the entire business. The market cap is the price per share multiplied by the number of outstanding shares. The number of outstanding shares varies as companies issue, buy back, and split shares. When investing in the stock market, you want to know how much you're buying the businesses for and how much the businesses are profiting. You can think of it as if you're buying a rental property. You wouldn't buy a house without considering the price, right? If you buy a $100,000 rental property, you'd want to get at least $10,000 back every year. This would give you about a 10% return on investment. Apple profits a lot per year, about $65 billion. That's a lot. But the price to buy the entire business is about $2.6 trillion. If you were to buy all of Apple, it would cost you about $2.6 trillion and you'd profit about $65 billion a year. But that's only a 2.5% ROI. And when only buying one share, the proportions are the same. Look, I think Apple is a great business and they'll probably increase their profits in the future, but that doesn't mean it's a great investment if you overpay. Investors will buy assets and want to receive back enough income relative to their investment. They'll usually buy with the intention of holding for the long term. In the stock market, they'll use fundamental analysis to select stocks. Some fundamental analysis metrics are the price to earnings ratio and the price to book value ratio. Some popular investments are real estate, stocks, and bonds. Generally speaking, speculators will buy assets and hope somebody else will buy it back from them for more than they paid. They'll use technical analysis to select stocks. I don't have much knowledge about technical analysis, but I think a big metric is the simple moving average. And they'll take on extra risk in pursuit of extra gains. Some popular speculation vehicles are gold, crypto, day trading, and options trading. The main reason I try to stay away from speculating is the probabilities. Let's say you have a 75% chance of doubling your money, but if you miss, you lose it all. You're more likely to lose it all after only 3 times. Look, speculating is not wrong. People have made plenty of money doing it. You can implement both investing and speculating, though I think it's important to know which strategy you're using. So that's all for today.